Hello, innovators, entrepreneurs, and risk takers. Welcome to another episode of Web3 with Sam Kamani podcast. And today, on this podcast episode, I am interviewing Marko from Tapir Protocol, where he is going to be sharing with us what they are building and how they are making DeFi more secure and safe for everyone. So especially if you work in the institutional crypto space, if you manage a fund, or if you manage money or have access or exposure to stable coins, then this episode is for you. As always, nothing that we talk about here on this episode should be taken as investment advice. And as always, please like, share, subscribe, and follow. With all of that out of the way, let's get into it. So, Marko, welcome to the show. It is great to have you here. I am so looking forward to talking with you about everything that you guys are building, as well as everything going on in the world of stablecoins. But before we even get into that, I would love to learn a bit more about your own personal journey. How did you get involved in this industry? What made you start Tapir Protocol?
Yeah, perfect. Thank you very much for welcoming me on the show. I'm a big fan of what you're doing. A little bit about myself. I'll make it short and make it crypto related. But before crypto, we have that in common, actually. We just discussed it. I was involved in e-commerce and was doing e-commerce startup. But I was, since 2015, I got crypto pilled and I wanted to get full-time in crypto, but had this other business going on. But anyway, I transitioned 2020 in crypto, didn't know exactly what to do, did a couple of hackathons. We won some prizes on hackathons, on East Global hackathons, East Online in
Yes.
2020, then in 2021 as well. And the first main thing that I did was in liquid staking. I basically designed and architected the first version of Marinade Finance. That's the first liquid staking solution for Sol on Solana.
Yep.
Yeah, so that was like the first major thing. Shortly after we got the initial funding, I basically transitioned back to Ethereum and focused on other Ethereum project. The next of
Yes.
which was SSV Network, where I was doing where I was leading a developer ecosystem and basically helping succeed the big grantee community of more than 20 grantees that were building on SSV. SSV is an infrastructure solution for Ethereum staking. I also did the DAO variable control framework for setting correctly the DAO controlled variables, and is basically the focus on the mechanism design of the product, risk analysis. That kind of brings me to another thing I did for Diva Foundation. I was doing analysis of their mechanism design, tokenomics modeling, but I knew I wanted to do my own thing, and then basically Tapir, what I'm building now, is kind of accumulation of what my strengths are and what I believe the market needs. And the strengths that I have and that I think I can bring value in is risk analysis and mechanism design. And especially Tapir is building something to help DeFi grow up and basically have risk mitigation tools for the investors. Have something that allows you to not have exposure to all the DeFi Legos, to all the 10 different protocols that create your position, which can have a very nice yield. But the problem is it's hard to measure the risk, it's hard to price the risk. And that's what brings us here, I guess.
Definitely. I mean, like earlier we were just talking about that. Like, I've seen like the growth of stable coins, and it has been like exponential growth. In a way. Now I think I was seeing now stable coins are bigger than Ethereum, or somewhere I was reading. Is that right? I haven't checked the market cap together of the stable coins, but it might be. And look, I won't be surprised if like stable coins are the biggest asset by market cap in few years. I mean just what I feel like, that's where how the industry is going. If you look at the trading volume or transaction volume of stable coins, it is through the roof. It is in hundreds of billions. of dollars. It's accepted by the mainstream industry. It's no longer like a niche Web3 or blockchain or a crypto thing. It's used everywhere. With its use, it brings issues and things like that. So first question is, where do you see the whole stablecoin ecosystem going? Are you also bullish on it? Are you, yeah, where do you
Yeah,
see?
yeah, I'm very bullish on it. I think there are two things on the stablecoin. Stablecoins in general, or what people call stablecoins. One is just the transaction use case, which is huge. Replacing to some extent Visa or other payment networks. The payments we all know are instantaneous, extremely cheap. Something which can't be said for cross-border payments in traditional markets. So that's one thing. The other thing that we are actually focusing on is the yield part. Basically, what DeFi can bring is stablecoin-like products. They are not strictly speaking stablecoins, but a lot of them they are tracking the price of USD. But they bring substantial and nice yields to them, like 10%. And this class of product is something that Tapir is specifically built for, to get the really nice and juicy DeFi yields, but protect the downside of something going wrong in any part of the stack. If it's the stablecoin itself, if it's one yield strategy, if it's the other yield strategy, bridging risks, smart contracts risks, economic exploits. There are many diverse risks.
Yes.
So yeah, that's how I kind of
Definitely. And the other thing I saw that what Tapir solves is like protection from the risk of depegging. Can you please explain that a bit? How does that work?
Yeah, exactly. So let's let's be a little bit concrete and actually not it's not actually funny, but it's interesting. Like even the I'm looking at the newsletter today in DeFi, and actually this newsletter has a section called stablecoin depegs. So unfortunately, this is no longer kind of a niche thing. And from
Yeah,
this, I look at the APX USD stablecoin that is currently trading at 80 cents on the dollar. So, and I think this is kind
that's
of a
crazy.
good case study to go through and kind of tell your listeners what would happen with Tapir. So Tapir is specifically made for this kind of an investment product. What is APX USD? Maybe a lot of people don't know it. It's not a traditional stablecoin. It's this kind of a new class of stablecoin that is some kind of a yield strategy wrapped into a coin. Specifically, they are heavily backed by STRC and DAT preferred equity exposure. Basically the debt that strategy is issuing, and they are putting it on chain. There's nothing wrong with that, but obviously this is a risky position, and they are currently at 80 cents on the dollar. What would happen with Tapir? With Tapir, you are able to get, Tapir allows you to separate the risk from the investment itself. Okay, so what does this mean? Right now you have APX USD. With Tapir, you have depeg-protected APX USD and yield boosted APX USD. Okay, so suddenly you have like three investment opportunities with different risk profile instead of one. And the depeg-protected version gives you what it says, a depeg-protected version of the same investment. The important thing is it's 100% capital efficient. You are still getting the underlying yield. Let's say it's around 10%, so you're still getting the underlying 10% yield. But with the depeg-protected version, this situation happens. It goes to 80 cents. You still get 100% back. You don't get 80 cents on the dollar, but you get back 1 to 1, but together with the yield. That is important. Okay, but obviously this can't be free. So instead of
Yeah, that's exactly what I was going to ask. Yes, so continue.
yeah, so it's not out of the thin air. It's 100% capital efficient because it brings all the yield with itself, but obviously it costs something. So instead of 10%, you would get 9 or 8.5%. This
That
is
would make
basically
sense.
the cost, but this is purely the cost of the depeg protection, right?
Yes.
So, and this 1.5% then goes to the yield boosted asset. So you have this depeg protected version, you have the base version, and you have the yield boosted version. And this yield boosted version will get not 10%, but 11.5%. It's important to note that this is a market mechanism. We don't set the exact rate that it has to be 1.5% or 1%, but this is reasonable to expect for the APX USD. So yeah, and in this case, what would happen is basically you get all your money back as as the holder of the depeg protected token, and you get the 9.9% yield. And as a yield boosted version, if you hold the yield boosted version and you are more a risk on investor, let's say you are part of the team, or you can do your own due diligence, you are highly sophisticated, have a team of quants and can like assess the risk,
Yes.
well, and you would be buying the yield boosted version that gives you higher yield. But obviously, if there comes to a depeg, if there is a 20% depeg as there is right now, your depeg would be actually twice the depeg size, so it would be 40%. So you would take a 40% haircut. So this is an unfortunate. Obviously, if we are talking about small depegs, it's better for the holders of the yield boosted one. But this is a very legitimate market mechanism. Market decides, what is the price of the depeg, and this is also kind of a secondary thing for the DeFi itself. Currently, not, if you look at traditional news, they a lot of time talk about, how much did the risk increase of some stock, how much did the volatility increase of some stock, and a lot of this information they get from, they look at the options trading, and from then that you can look at what is the implied risk of price going here and there. And this is something what Tapirs give you for DeFi. Tapir, whenever there is an asset which is being traded on Tapir, it basically provides what is the risk cost of a particular product, which is super useful, to have in general. The same as with prediction markets. Everybody's quoting prediction markets, even though they don't use them. It's a great signal for risk in DeFi.
Yeah, absolutely. Because you'll also collect all the data as like, so you'll get to see firsthand that how the market volatility is pricing the risk. As you said, that you don't set the rates, it's set by the market based on the demand and risk profile.
Exactly.
How does a taper make money for itself, or like what's the monetization strategy, or is it just like basis points of the transaction value or something like that?
Yeah, you hit the nail on the head. We didn't, we focus on the risk. So our
Yes.
model, our mechanism is super simple. Our monetization is super simple as well. It's exactly as you're saying. It's a marketplace model, so we take a small fee, basically not on trading. If you want to be a liquidity provider, actually you are getting the trading fees. There is a small trading fee that also goes to treasury, but for basically minting or redeeming the asset. So basically, when people are buying in, there is a small fee, and that's the revenue for the project.
Yep, that's fantastic. Where are you guys on your life cycle as a startup?
Yeah, where we are right now, we actually
Yes.
have everything launched. We are basically, before we let external capital in, we are super conservative on the risk front. Like the one thing you do want is like the risk product that you are holding, the team behind it to be very risk
Yes.
averse, right? So we
Yes.
are just running, with our own funds, running all the monitoring. Then we have set up, just observing the whole system. And next week, we start to let the external capital in. First, our launch partners, the first launch we are launching a very interesting product, which is Zircute USDC with relatively conservative strategy and with good managers. They can generate around 9% on USDC. So And this is the first pool we'll be launching. We have launched actually, not that we'll be launching, but we will basically allow the partners of the project and also participants who are very close to the project and participated in our public testnet round and are eligible for private mainnet. Maybe for your listeners, if they are interested about getting in right now, just from the we want to see how things go. If everything is super clear, we have like this stage launch. So we will let the partners in, then basically people close to the project, and we can talk to directly, and then we'll basically open it up to the public once
Yep.
that some nice capital is in and we have observed the system for some time.
So would you say that anyone with like a treasury could be a potential client for you guys, like a treasury, DAT, anything like that?
Yeah, definitely. Anyone basically who is aware of the risks in DeFi, which I think most people nowadays are, you know.
Especially after the April we have had.
Yes. Yeah, like the main developer from OpenZeppelin said that like he doesn't recommend DeFi to his friends. So yeah, I mean, DeFi is in a hard spot. I think we'll grow stronger for it, but Tapir is super relevant here, and I think it's relevant for any DeFi investors. We are not living in the bubble, so you can currently get around 4 to 5% on treasury bills, which are quite safe, right? But with this first product, you have 8% USDC. You'll probably be able to get around 7% depeg-protected yields, or you can also do LPing. We also have incentives in place to basically help us grow in the first phase of the project. So I think Tapir is good. Like, I don't want to say anyone, but people who are risk averse, who really understand that there is nothing like free lunch, and every investment carries risk with itself. So I think 7%, very low risk profile is nothing to scoff at. We also target 20 TPR incentives on top to kind of sweeten the deal.
Yes.
We definitely need liquidity provisioning. So if people just think like 9% is okay, and this first product is, I think, relative good on the safety front, is relatively safe. So people could also LP provide liquidity on the platform for additional set of incentives. This is a thing basically because we are not a direct participant in the market. I don't think that would be good. We are creating a marketplace. So people who think this is something that DeFi needs, are bullish about the project, can get exposure to the protocol by doing liquidity provisioning. There is no impermanent loss on liquidity provisioning, so that is the other category. So one is people who want really good yield, but yield at risk. Good
Yes.
risk yield profile. That's one category, which I think should be kind of all of DeFi. But
Yeah.
secondly, people who think this is something, who believe the same as we do, that this is something the DeFi needs, and this is the trajectory will go forward in the future. This is kind of the
Yes.
easiest way for them to participate, to provide the liquidity, earn all the underlying reward of the protocol, and yeah, also Tapir incentives on top.
Yeah. Yeah, it is definitely, like, I agree with you what you are saying about like DeFi, that it is in a challenging time at the moment, because we have gone from the highs of 180 billion in the total sort of, or the TVL of all of DeFi. I'm sure you look at DeFi Llama as well every from time to time.
Yeah.
And now it's at what, 69 billion or something like that, the last I looked at. But what I'm really worried about is just like Fable 5 got released today. Like, you're allowed to use Fable 5, and I have developer friends, and they're like, oh yeah, we are able to find so many bugs. I mean, these are Web2 developers, not in Web3, but they are able to find so many in like SaaS products and other products, even inside their own company. They say that they've had, like, given it to outside testing teams and security teams, and they haven't been. And this is like mid to large size in companies, and I won't share the names of those big companies, but yeah, they're able to find so many vulnerabilities in the code. So I'm worried, like, will people be able to find more vulnerabilities in other random DeFi products? And even though they had might have nothing to do with what any of us do, but just because someone's smart contract gets hacked, the whole DeFi loses TVL every time. Like in April, it happened a lot, like around April, early May. There were lots of hacks in the DeFi ecosystem, and it lost a lot of TVL because people get scared. And I think this is why you guys can really plug in that gap. I feel like by giving some depeg protection.
Yeah. Exactly. I 100% agree with you. I think we are in a hard time no matter what. I think it's blessing and a curse for us,
Yes.
particularly because we focus on the de-risking. Obviously, it is not good for DeFi in general, and that includes us, right? It's a blessing in a sense that we are kind of made for this. Also, we have had two independent audits. We will also. I have done a small audit with Fable before. They just, at the time of recording, they just released it again. So we'll do a security check with that as well. And we also have a very small code base. Like all of the libraries, all of the code that we have
Mhm.
is below 1,000 lines of code.
Amazing. That is
Yeah,
so good. My last company that I was working with, or that I was helping, they had 1.5 million lines of code, so slightly bigger
yeah.
and very complex. Yeah, the more complex things become, the harder it gets to maintain and
This
stuff.
is this is kind of what my background gives me. Like the simpler the mechanism and the easier the code, the shorter the code, the less rooms for exploit there are and less attack surface there is, right? Why am I saying this? So we want to be, the safest part of the stack. But it's important to know that in other investment opportunities, for example, you have like one of the highest yields still on Pendle. I'm just looking like at the Pendle markets. They are basically a DeFi fixed yield
Yes.
platform. They have around 20% fixed yields, right? But what is the catch with this? there is there is a complex strategy in, behind the doors here. They have like the USD3 protocol here that I'm looking at, and basically there is some underlying strategy that what are the risks, right? Like there's 20% yield,
Mhm.
but what are the risks? The risks are these are usually new untested protocols. There is obviously the Pendle code base, which is quite complex. There is the code base of the protocol itself, the underlying protocol.
Yes.
There is also usually some kind of special strategy that the protocol is running. So the risk exposure you have is quite extensive, right? But with Tapir, when we basically launch this product, the risk comes down to our code base, right? So the investor or even the super risk averse investor just needs to look at and do due diligence once on our code base, and any investment opportunities that are listed are just vulnerable to this code base. So
Yes.
I think this is underappreciated, but for like larger players, it takes a lot of time and effort and a good technical team to explore the new high yield DeFi opportunities. And this is what basically Tapir is great at and shines at, that basically the attack area just collapses to our code base.
Yeah. Yeah. I completely agree with that. I had another thing I wanted to ask you. What is your view on like algorithmic stable coins?
It depends what
Yes.
depends on the details, right? What kind of
Mhm.
algorithmic stablecoin are we talking about? it's a huge design space. We would have to talk specifically about some particular stablecoin. The issue with moles, I mean, Terra Luna is a good example.
Yes.
It's a stablecoin that was backed by a volatile asset and has a positive feedback loop. Positive just in the mathematical sense that it strengthens. As the price of Luna went up, like the stablecoin, the backing went up, but as it goes down, like the backing also went down. So
Yes.
a lot of algorithmic stablecoin have this kind of a positive feedback loop, which is actually quite negative.
In the long run, yes, it has proved to be quite negative.
Yeah. How I would summarize it, like can can they survive run on the bank if there is a stress test and suddenly people
Yes.
like lose confidence? Can they survive it? Can they unwind? Can the protocol unwind its positions gracefully without losing the peg? That's
Yeah. Yeah, definitely. I was just looking at a document I think which I got from your company itself on the long-term depegs in crypto assets, like between 2020 November and end of last year, November 2025, and then you had like a few different categories. But I'd let you explain how do you look at what are the different types of depegs that can happen in like stablecoin.
yeah. The document you are talking about, we did like analysis of the depegs in crypto assets.
Yes.
Firstly, probably everyone knows, but I just briefly, what is a depeg? Depeg, you can think of a stable coin is a pegged asset. One USDC should equal $1, right? A depeg means
Yeah.
when it no longer is worth $1. If one USDC is worth 95 cents, it means it depegged 5%, right?
Yeah.
In this analysis, we looked at depegs in crypto assets. We only looked at long-term depegs. Why? Short-term depegs can make the headlines, can make the news, but are not structurally problematic. If they are large, they are problematic because they can cause liquidations, obviously.
Yes, indeed.
But they can happen. There could be a very short depeg on one exchange, as there was with Athena, but it didn't really mean that the project was insolvent. It was just a very short-term market dislocation. So I don't think they are that relevant. What we looked at in this analysis are not the short-term depegs, but on the long-term structural depegs, meaning they are longer than 30 days. We also didn't look at the depegs of non-algorithmic stablecoins. Actually, the analysis is only of non-algorithmic because, yeah, I don't believe algo stablecoins are viable, or at least most of them. I don't want to throw all of them into one bucket, but with caveats, the the what makes sense to analyze is the depegs which last more than 1 day, and yeah, are on non-algorithmic stablecoins because Terra Luna crash would skew how much losses were there for the depegs. And also, what I didn't mention, we focused on what was the value destroyed by the depegs, what were the losses, right? And it's important to note like these strong guardrails that we had. Like we didn't look at algo stablecoins. There would be like a huge TVL loss if you look at Terra Luna, and also we didn't look just on the short-term effects. But the kind of the moral of the story, or what we found out, is that long-term depeg, which is important to note, like this year there have been many hacks and depegs because of what is happening with AI and myriad of other factors. And this is not even covering this year. So long-term
Yes.
total loss that we found out is between zero point 0.4 and 1 billion. And these are depegs which last longer than 30 days. And basically the losses caused by force unwinds and liquidations are estimated to be this. And when we look at a little bit shorter depegs, 1 to 14 days, the cumulative losses is 0.7 billion to 2.3 trillion, which basically brings us to, for the 2020 to 2025, depegs were responsible for the losses 1.5 to 3.3 billion, which is a huge
That's
number, right?
crazy.
Yeah,
Yes.
that is a crazy number, and it doesn't include anything that happened this year. Yeah,
Yeah.
so
And there has a lot that has happened this year, unfortunately. I wanted to find out like there are few other players that I have come across in the market, like like Y2K Finance or Corp Protocol, or and then there's like completely other side of the spectrum, which is just like a type of like an insurance company where you just go and buy insurance for whatever crypto you hold, like companies like Nexus Mutual and things like that. They do that type of like protection against loss, and that loss could be due to anything from kidnapping to hacking to depegging to
yeah,
anything like that. So yeah, how do you guys differentiate yourself from all these other types of protocols and things like that out there, or other services?
yeah. That is a great question. So how are we different, and what is the current landscape?
Yes.
The current landscape is, you mentioned a couple of protocols, but the biggest one is still Nexus Mutual. The
Yes.
others have failed for various reasons. How do we differentiate? We think we have the right model for DeFi. There are many ways how to skin the cat and how to provide risk protection for the users. Why are the other protocols struggling, and how are we different? So we have a very different model from Nexus Mutual or from the more traditional models. The problem with those things is twofold. They are not very capital efficient, especially
Hmm.
in higher yield DeFi.
Yes.
That's one thing, because the coverage itself is usually paid in some stablecoin that is not yield bearing. The other thing is, for the buyer, there are two sides always, like the buyer of the protection and the seller. So the buyer of the protection usually has to read the fine print. What are they actually protected against, right? They also,
Yeah.
is it only smart contract hack? Is it this? Is it that? Does it include front end? Does it not include front end? Right. So there is a lot of fine print. They also need to trust that basically the whatever protocol will honor their claim. There is usually some committee which decides if the claims are valid, right? So there is like this uncertainty into decision process. And thirdly, and this is a big thing, if it is like a traditional coverage model, like they need to believe that the person or the entity who is providing the coverage can actually deliver on their promise, right? And this is
Yes.
not trivial, like, from two things. Like, if you look at traditional finance or traditional insurance, there is a huge regulatory apparatus, you know, for the insurance business, exactly because they need to make sure that users or that regular people who buy insurance actually can get paid back, that the insurance doesn't go bankrupt. Insurers have like reinsurance, so they can like reinsure their claims, and there is like a
Yes.
lot of legal protections in the traditional finance because it's not trivial. So that's one thing. Like the user with these traditional models in DeFi doesn't get any of these protections that they do have like in traditional finance. So this is one of the problems. Yeah, the other issue on the seller side, on the people who are providing the coverage, it's usually that there is some pool. The protocol has some pool which which provides the coverage, and a
Yeah.
lot of times in other projects this is very capital inefficient, and it just doesn't make sense economically to provide this coverage, because usually the coverage itself doesn't bear any yield with itself. So an example
Yes.
is, if you are covering a protocol that can has a yield of 5%, some liquid stablecoin that is yielding 5%, and you are covering it, you either need to cover a large one of your dollar either needs to cover a large amount. So $1 needs to
Yeah.
cover more than $100. The more you are covering, the less the buyer of the product can be sure that you actually have some money left when there is a big incident. There are then more conservative model when $1 covers only $1 or $2. In this case, then it's very capital inefficient, and it basically the person who is taking on the risk needs to get at least these 5% that the instrument is giving. If you are covering each staking product that gives 5% yield, you need to get at least 5% in return and more, right? If you are
Yes,
you are
exactly
undertaking
right.
the risk of this product, and this usually, this is where the math is breaking down also for the other side in these traditional models.
Yeah.
How did we approach it, and why do we think our model is better? Our model is super simple. All of our resolution is fully automatic. We use multiple Oracle sources across multiple time. So we are making sure that the price resolution is automatic and it's fully robust, just to give confidence to the buyers of the depeg-protected tokens that it's going to be really protected. We also ensure that there are actually funds left to pay out the protection. This is kind of the other thing that it's hard to do in DeFi. How do we do it? We do it by just having a different claim on the underlying. So the protocol has the underlying, so it is generating full yield, and it also has 100% on the underlying. So if there is a loss, users can be sure that they have claim on the underlying. It's not with us, it's with the smart contract, and
Mhm.
all of it is there. So what is the cost for this? The cost for this is that the coverage is up to 50% of the depeg, and then the buyer of the coverage also experiences some loss. And this is
Yep.
the necessary constraint of the system, right? Because we are covering the position with the underlying itself, right? If we did it in any other way, if we did it with just USDC, that would be capital inefficient and wouldn't make any sense, right?
Yep.
That's one
Even
thing.
USDC has had a scare in past. When was it? Was it 2024, 23? Sometime it nearly got depegged once.
It did get depeg
USDC.
significantly. I think even more than 10%. I can't say exactly from
Yeah,
the top of
something
my head.
like that. Yes.
Yeah, but there
And
was a huge scare. Yeah.
yeah, and in order to move, I remember moving it. It was on ETH, and so many people were moving it around to other assets, or swapping it to other assets and stuff, that I had to pay an enormous amount, like hundreds of dollars in transaction fees for not that much money either, like just for a few $1,000s. So it was yeah, it was an interesting time.
Yeah, that's why we are building to peer. Yeah, this
Yeah,
is it.
yeah,
Also,
that's yes,
I
yes. Go ahead.
wanted to touch on another thing. So this is one thing why we think our model is good. Like it's just to sum it up, it's fully non-custodial. The coverage is very clear. The Because like with traditional models, the coverage is only as good as the funds that the underwriter holds. With Tapir, the protection, is very clear, is up to 50%, and then the depeg-protected holder experiences some loss. So that's one thing. Also, the protocol is very simple. That's also a differentiator against other products. I know, like recently there were some hacks, even like on this risk protection product, and that's like the last thing you want is that the risk protection you are getting being hacked. So yeah, the simplicity of the design and of the product itself, I think is a huge strength on its own. Yeah, so that's basically my 50 cents there.
Yeah, this is the right direction to go in. I have one more thing I want to talk about. When we look at like the stablecoin market cap, and like the whole stablecoin space, like 98% is dominated, or if not even more, by US dollar denominated stablecoins. Do you think we will see any change in that in future, or do you still think we will continue to see this level of dominance by US dollar denominated stablecoins?
Yeah, that's a good question, and we'll see. I have some good friends who are building Wi-Fi virtual finance. Shout out to them, and
Yes,
they are actually addressing this problem. They are creating a nice system how to bring on chain small currencies, small third party currencies. So yeah, if they succeed, hopefully we'll see more. I think the general trend is that in monies, like wherever the money are concerned, the the strong became become stronger. So the dominant player
exactly.
usually takes the majority of market share. So I don't see dollar being displaced anytime soon. That being said, there are also we need to think of a different uses of stablecoins, right? One is just holder of value, like you can hold US dollars whenever you are in the world, which was not true before that, and you can hold it,
Yes.
cheaply, no transaction costs, etc. So this holding use case, I think, in that dollar will dominate. But there are other use cases like transaction use cases. If you just want to transact
Exactly.
with the outside world, this is a huge use case that many people from like the smaller countries
Hmm.
work outside. They go to Europe or to US for work. They still have family in their own country, and yeah, so I believe like for these use cases, transacting money, or if there are any, there are countries that have restricted capital flows on their currencies, and this is one way how to, if there is a digital representation which is not controlled by the government and they can use it. This is another use case where I think it makes a lot of sense for much more smaller stablecoins to be. Yeah, so that's
Yeah.
my kind of
Yeah,
thought.
definitely. It's like, I mean, this makes me only more bullish about our industry, even though despite the times or whatever you look at coin market cap, because there's only going to be more different denominated stable coins as people need to transact in other currencies as well around the world. Despite US dollar dominance, we still have like things like the Swiss franc and Singapore dollar and a lot of other currencies that have done really really well in the last few years, like really appreciated, really strong, stable governance in their own country. Then we will see a lot more assets denominated, whether it's Australian dollars, yen, renminbi, whatever, like euro, definitely. And then that means there will be need for all these other products and other companies that can come in and solve problems in those sort of denominated currencies and stable coins. And so yeah, I do think that the whole space is going to continue to grow at this tokenization, stablecoin, RWA space, and that will create a lot more opportunities over the next couple of years, 2 3 years. But having said that, coming back to Taper, so what's next for Tapir? Do you have a key ask? I know not for you, like a lot of founders who come, like pretty much 80% of the founders I talk with at different stage, even if they've done a
Yeah,
series
yeah, yeah.
D, E, they are still always raising,
Yeah,
and some
yeah.
are always looking for talent, some are looking for partners. Anything, feel free to share.
Yeah, so where we are at, as I've said, we have just launched. We'll let our partners in the upcoming week. If you are interested, excited about Tapir, want to use it, you can already use it on testnet. If you want to get to our private mainnet and perhaps get exposure to Tapir that way, or just want to use it for what it is right now, yeah, send me a DM on Twitter, and I'll I'll see what I can do to add you in to first cohort of users we'll be letting in. Yeah, that's one thing. The other thing is, yeah, just reach out to me on Telegram, not Telegram, sorry, Twitter. Twitter is best way to connect with me. Read our Substack, give us feedback. That's the main thing. We'll be launching other projects soon in the upcoming weeks. We'll be focusing on really the high yield, high risk stuff. I think that is this where it makes most sense. So stay tuned for safe yield around 15%. If you're interested in that, stay tuned. Also, let us know which if you are a fund, if you are a manager, managing some fund, or you just have capital on your hand that you would want to safely invest in DeFi, reach out to me and tell me what assets would you like to see, because our main constraint with launching new markets is that we want to see the demand, because for the trading to be sufficient and to be a good user experience, we need to have a products that have demand. We have some ideas about what these products are, but to hear directly from you what products would you be interested to have depeg protection on, that's kind of a lot.
That's
That's what we ask
that's
for.
fantastic. Yeah, you know what I'll do is I'll put links to everything that you guys are doing in the show notes and description, so people can read, find out, reach out over the next, because this will be permanent content on Spotify and Apple Podcasts and Amazon and multiple other channels forever. So yeah, people can continue to reach out to you guys. And thank you so much, Marco, for your time. It's been an absolute pleasure talking with you, and I'm sure we'll connect somewhere in the world over the next conference or somewhere.
Yeah, crypto small. Yeah, thanks a lot. Yeah, it was a great chat. Also, I haven't mentioned my handle is Marko in Ether, all small and with K, Marko with K. Yeah.
Fantastic.
And once again, thanks a lot, Sam. It was great talking to you, and we'll definitely see you around.
That's it, folks, for today. And if you got value out of this conversation, you enjoyed it, then do not forget to share it with your crew and leave a comment, like, and subscribe so you do not miss the next episode, because we will be sharing a lot more insights and industry secrets as always. And also, nothing that we talk about here should be taken as investment or financial advice. And if you'd like to collaborate, if you'd like to be a guest on the show, or if you're building something really interesting, then I want to hear from you. Leave it in the comments, reach out to me. You will find all the details in the show notes description, or just search for Sam Kamani. I look forward to seeing you again in the next episode. Peace.